$5 trillion. That's how much trade now moves between BRICS economies every single year. And a growing share of it is no longer using the US dollar. This is not a theory, it's not a projection, it's already happening through local currency agreements, energy deals settled outside the dollar, and payment systems that don't rely on Western clearing networks. For decades, global trade followed a simple formula: invoice in dollars, settle in dollars, recycle those dollars into US treasuries. That loop is now being bypassed. And when trade stops needing the dollar, demand for the dollar system starts to change. BRICS countries now represent a major share of global population, energy supply, and commodity production. Trade between them has crossed into the trillions, but the real shift is not the volume, it's the currency being used. Russia and China are settling large portions of energy trade in local currencies. India has purchased oil without routing payments through the dollar. Brazil and China signed agreements to settle trade directly in their own currencies. Individually, each deal looks small. Together, they form something much bigger, a parallel settlement structure growing quietly alongside the existing dollar system. This doesn't replace the dollar overnight, it bypasses it at the margins. And in financial systems, marginal shifts are where structural changes begin. The mechanism is straightforward. Central banks extend currency swap lines to each other. Two countries agree to invoice trade in their own currencies. Payments clear through domestic systems instead of dollar-based networks. No dollar funding is required. No need to source offshore dollar liquidity. No automatic recycling into US financial markets. That matters because the dollar's dominance isn't just about reserves sitting in vaults, it's about continuous transactional demand generated by trade. Global trade creates demand for dollars. Those dollars often flow back into US debt markets. That demand helps support treasury issuance and maintain global liquidity conditions. If even a portion of a multi-trillion-dollar trade bloc shifts away from the dollar, marginal demand begins to soften. Not collapse, soften. And the global monetary system runs on marginal demand. At the same time this shift is unfolding, central banks have been accumulating gold at the fastest pace seen in decades. Gold settles outside the dollar system. It carries no counterparty risk and requires no clearing network. Silver demand has also strengthened alongside industrial supply constraints, positioning it as a secondary hedge in a more fragmented liquidity environment. These are not random commodity moves, they are balance sheet responses to a world where trade settlement is slowly diversifying. This is not the end of the dollar tomorrow. The dollar remains the deepest liquidity pool in the world. It dominates reserves and financial markets. But systems rarely fail all at once. They lose share gradually, especially at the edges. A parallel trade channel growing into the trillions is not noise, it is a signal. A signal that the monopoly on trade settlement is weakening. The real question is not whether BRICS can replace the dollar entirely. The real question is how much trade can migrate outside the dollar before the effects begin to show up in treasury demand, liquidity flows, and funding markets. Because the dollar system depends on external demand to function smoothly. And that demand is no longer unquestioned. The bypass has begun.